Good morning, everyone. This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, September 15th at 7 a.m. Mountain Time. Our note this week was titled, History is a Pack of Lies. And it's an old Voltaire quote. And the idea was that we got that larger than consensus, not so much larger than we expected, first estimate of the annual benchmark revision. And the way history was written was something of a lie. I won't go into the backstory about all that, but our note really was about the conditions of the labor market, a little bit less about inflation, and a pretty extended preview of the FOMC meeting this week and the implications of potentially realizing our forecast of 100 basis points of rate cuts either in 2025 or by very early 2026, and what that means for the economy and a potential broadening out of markets, equity markets in particular, and earnings. So there is an argument to be made that we've been in at least a labor market recession or recession light since March of 2024. Now, the pushback we would expect to receive on stating that would be, well, look how strong the GDP numbers were in 2024. It was a very suboptimal mix of growth for the markets, for broad-based earnings, for the small business part of the economy as a whole, for the outlook for productivity over time, and per capita income as well. We had very strong government spending, very weak capital investment, and a labor market that was struggling mightily. We don't understand why for 3 years the BLS has been overestimating small business employment, and the Fed never figured it out really, and the BLS never figured it out really. It was obvious for us that this was going to occur, given that the Fed eased primarily using their balance sheet and tightened primarily using rate policy, which put the burden of tightening on small businesses who are floating rate borrowers, small banks that are sensitive to the shape of the yield curve. This has been something that's been a constant theme of ours for 3 years. And the chickens kind of came home to roost last week when we got that negative 911,000 first estimate of the annual benchmark revision, which implies that the growth of employment right now, private sector employment, is zero. That is recessionary levels. Typically, then it would mean it would go negative and we'd have layoffs. We may be able to avoid that, but if we avoid it, it will be because the Fed cuts fairly aggressively and steepens the yield curve out here. So in our payroll or our FOMC preview, we went through the concept of hysteresis, and in essence, deeply ingrained in the belief system of the Fed staff, of the FOMC participants, is that inflation is always and everywhere a monetary phenomenon, and their tools are much more effective on inflation than they are on unemployment. Hysteresis is the idea that if people are unemployed for an extended period of time, they lose skills and it's tougher for them to re-enter the workforce. And so this is why the Fed's bias always seems to swing more to unemployment, because they think their tools are more effective on inflation. If you look at the June summary of economic projections, they have inflation basically going back to target in 2027, but unemployment not going back to target, or their idea of what the longer run equilibrium rate for unemployment is, throughout the entire 3-year forecast horizon. So rightly or wrongly, that is the Fed's reaction function. And they do need to get focused on that. So with respect to their forecasts, they had the policy rate ending the year at 3.9, which would imply 2 cuts. That's not enough. They had their policy rate only going down 1 25 basis point cut in 2026. That's not enough either. That'll be the key as to whether they disappoint on those forecasts or not, as to how the markets react to all this. As far as the inflation numbers go last week, the bottom line is that the break-even inflation curve was unchanged, and the inputs into the Fed's preferred measure, PCED, imply we're only going to get a 0.2 on that at the end of the month. I think the BLS lost additional credibility when their housing metrics all ticked up last month. That's nonsensical. No other measure shows, any kind of upward pressure on housing costs right now. And the services component, non-housing services component of both CPI and PPI were fairly weak. So there's nothing really to see on the inflation front. We're not going back to 2, but inflation is stable here, and the Fed should be addressing their employment part of the mandate. So from a market's perspective, 10's reached our target of 4%. Mortgage spreads are still tightening. We do not like inflation break-even steepeners, the idea that you should be buying, betting on higher inflation over the next 6 months or a year. It's actually probably going to come down, not the 2, but coming down nonetheless. And we continue to like leaning into a rate cut cycle, which means, small caps, investment sensitive sectors like industrials, and a little bit less exposure to tech. That's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.